大家好，欢迎来到 YouTube 大佬透镜，我们用一张 PPT 解读财经大咖的深度分析。今天是2025年11月13日，我们来分享大摩亚洲团队今天上午的闭门会。先看要点，亚洲消费展望，亚洲消费复苏主要受劳动力市场和工资增长驱动，资产负债表压力仅在中国大陆及香港显著，其他经济体无明显去杠杆迹象。中国稀土出口管制，中国控制全球2/3稀土矿产以及超过 85% 的精炼及永磁产能，供应链多元化需要3到5年。中国的许可机制逐案审批1年有效期，军工和国安领域难获批，中国保留最终解释权。中美贸易战3个情景，基准是最可能的，休战维持，小摩擦不破局，利好 AI 本地化和出口链。熊市，贸易战重启，互加关税加上非关税壁垒，轮动至内需，高股息防御， AI 短期回调，中期加速本地化。牛市低概率，签订框架性贸易协议，关税进一步下调，通缩2026年下半年结束，高Beta成长如软件、互联网、汽车。若美芯片解禁， Nvidia AMD 将抢占中国的 AI 算力，从而压制本地化股票。中印关系，边境缓和下贸易逆差已从2020年的400亿美元扩至1200亿美元，因中间品依赖中国未减反增，电子、化工、机械未来增速或更快。中国内需问题，股市上涨难以显著提振消费，需解决通缩、名义 GDP、企业盈利、工资传导链。好，要点我们就分享到这里，接下来是完整版，这里是 YouTube 大佬透镜，我们致力于过滤垃圾信息，挖掘优质内容，欢迎订阅、转发，常来。
Good morning and good afternoon, everyone. It is November 13, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you're a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Chetan Iyer, Chief Asia Economist, Upasana Chatra, Chief India Economist, Jenny Zheng, China Economist, Chloe Liu, China Agri Strategist. During this webcast, you can send us questions at any time from the Ask a Question text box. We have the Asian Econ team note, and then this is discussing the wage or and then this is discussing whether wage or balance sheet will matter more for consumption in Asia. Today, we are very happy to have Chetan joining us to share the expectations on growth. And then let me invite Chetan here. Thank you.
Yeah, thanks, Crystal. So I think the discussion is really centered around, as Crystal mentioned, when you're thinking about the Asian consumer spending outlook, what role is the balance sheet playing? So what we've done in this report that we just published this week is try to look at balance sheet situation across the region and then see whether that is truly weighing on the consumption spending or is it the labor markets. And to give away the conclusion, we think it's really the labor market that is more important. As such, it's only China and Hong Kong. Those are the two economies in the region which have seen asset price fall, which has been meaningful. And then in turn, that has affected the consumer's borrowing attitude. And so there has been some deleveraging in consumer balance sheet in these two economies only. But the rest of the region, we don't have that problem, i.e. asset prices are not falling, and therefore there are no deleveraging pressures. There are economies other than China and Hong Kong which have relatively high debt, like for example Australia, but we don't have any sign of consumer confidence getting affected because of high levels of debt, and there is no deleveraging happening either. Then just coming back to China again. So even in case of China, it's not that big factor, i.e. that there has been some negative impact of consumer deleveraging and the balance sheet situation on the overall spending. But we think that the bigger driver, so if you were to look at China retail sales, it's very highly correlated with what happens to wage growth. And we use the household disposable income series to be like a proxy for wage growth. And that tends to be having a bigger explanatory variable than property prices or overall balance sheet situation for the households. And so parallelly connected to that, the other question that we get on China consumer balance sheet is this stock market rise, which has come through. Will that be a factor? So since I already just laid out that we don't think balance sheet is that big an influencing factor, we also think that the rise in stock prices is not going to be a big driver. Ultimately, what we need is policymakers to fix the deflation challenge. That will in turn lift nominal GDP growth. And then that in turn will allow the corporate sector to pay the workers higher wage growth, and which in turn will drive consumption. Moving to the second one in the region, which is also where we have this discussion on balance sheet's impact on consumption, that is India. And Upasana, who's also joined the call today, has done a lot of work on that. And our conclusion on India has also been the same, that it is not really the balance sheet issue that is holding back the Indian consumer. It's primarily labor market and wage growth. Again, on India's consumer balance sheet, there had been a concern because the central bank had earlier taken up interest rates higher. And then the concern was that the consumer's balance sheet is over-levered, especially the low end and the middle end consumer. But we've now seen that the central bank had hiked interest rates. They are now on the way down, cutting interest rates. But that previous hike in interest rates had no sign of a broad-based rise in NPLs. If the consumers had over-levered and that was the main reason why they were not spending and distressed, then we should have also seen that as interest rates went up, there should have been defaults, a lot more defaults in the consumer balance sheet. But as banks' results have shown again for this quarter, we don't see any side effect of consumer balance sheet showing up in form of rise in non-performing loans. And so then going into the outlook part of it, what is going to drive the outlook going forward? So we are expecting consumption to recover in the region by early second quarter next year. And the key driver we think will be the turnaround in the global trade cycle, particularly non-tech exports for the region. And we had published on this sometime back, maybe about 3 weeks back, that we do expect non-tech exports for the region to improve. And overall exports have been okay, but that has been primarily driven by tech exports so far. And unfortunately, tech exports don't have much multiplier effect in terms of job creation, so that has not really helped consumption. But once we see this non-tech exports recovery, we think that will be a key driver for broader recovery in the region and therefore consumption from early second quarter next year. So with that, let me stop here and hand it back to you, Crystal.
Thank you very much, Chetan. Before we take any questions on Asia economists, I'd like to move on to the next topic on China export controls. So recently, there are actually still a lot of moving parts on this issue, and our China Econ Strategy team, they have published a playbook on the China export controls. So today we have both Jenny and Chloe here to share the scenarios and also market implications. Over to you, Jenny, and then maybe we'll go to Chloe after you.
Sure. Thank you so much, Crystal, and hi, morning, everyone. So as we can see, Beijing has been increasingly using rare earths as a bargaining chip to counter the U.S. tech barriers. And today, China controls 2/3 of the global rare earth mine supply, over 85% of the refined output, and over 90% of the magnet production. And this dominance will likely maintain in the next 3 to 5 years, particularly for the rare earth refining and also the magnet production, because the supply chain diversification out of China is quite difficult given the environmental and also given the technical bottlenecks. So this gives Beijing more confidence to use the rare earth control to reshape the cost-benefit calculus of the tech restrictions by both the U.S. and its allies. And for now, it seems the U.S.-China tension is behind us because both sides have agreed on a one-year truce in late October. Over the last weekend, China also announced to suspend some export controls on dual-use items to the U.S. But here we just want to highlight that China only suspended the October version of the export controls, which is the strictest one and has the diminishedness style of the requirement. But China has not reversed the April rare earth controls on 7 key elements. And that means Beijing still retains the discretion in license issuance. And given that we think U.S. and China will maintain a competitive confrontation relationship in the coming future, we don't think China will fully abandon the export control leverage against the U.S. tech barriers. And the rolling negotiation and temporary escalation will be a new normal. So therefore, we think it's quite important to have a playbook in mind on different possible scenarios. In our base case, we think both sides can honor the one-year truce. There could be small frictions from time to time, maybe against the some sectors, against the some U.S. allies, but it's insufficient to break the truce to lead to a further tariff escalation or like a widening of the export controls. Then we think this scenario will be marginally positive for both China's economy and also the market. We think the 10% tariff cut can translate into 1% boost to China's exports, and that means 10 basis points boost to China's GDP growth next year. And the one-year truce will also reduce the supply chain uncertainty and give room for Beijing to strike a balance between boost to tech self-sufficiency and economic rebalancing. We think the local GPU can meet around half of China's AI demand by 2027. And Beijing can gradually step up the fiscal support for social welfare reform in the coming few years. And that can help the economy to shift from a 4-year deflation to low inflation from 2027. Then in a bear case, there could be an early breakdown of the one-year truce. That could be either due to some policy miscalculation or some unexpected political shocks. Then in time, both sides will conduct a mutual tariff hikes, and they can also escalate the non-tariff barriers. China on rare earths and the US on entity list, or even tighter semiconductor software controls. Then that can lead to a rapid strain on the global supply chain, sharp export growth slowdown, and prolonged deflation in China. Beijing can double down the supply-centric stimulus to support the tech localization. That would be good for local tech names over the medium term. But in the meanwhile, that means the economic rebalancing will also stall, and that make China take longer to get out of the deflation loop. Then in a bull case, both sides will move toward a framework deal as they will prioritize the stability. And that could be further U.S. tariff cuts, and we think the truce on the export controls can last for longer. I would say this is a rosy scenario, but if this happens, this will give Beijing more leeway to rebalance the policy toward the consumption and social welfare spending, then in this case, we think China can get out of deflation as early as second half of next year, and that will be faster than 2027 in our base case. But here you can see both bull and bear cases are extreme cases, and here we just want to use that to test the boundary. It's most likely that the US and China will still try to maintain a fragile equilibrium where the US receives China's rare earths and China receives some of the US's chips. And temporary frictions and negotiations are still likely, but we don't think there will be a decoupling even in our bear case. We think even if the bear case happens, it will be just a matter of time that both sides will back to the negotiation table and then return to the equilibrium. Now let me stop here and then hand over to Chloe to talk about the investment strategy under this scenario framework. Thank you.
Sure. Thank you, Jenny. So I will talk about the market and sector implication of these export controls. So basically, we think in the longer term, the US-China relationship could continue to be defined as competitive confrontation on many fronts. And actually, in the past years, we have seen multiple rounds of escalation, including on the tariff, ADR delisting, executive order and entity list restrictions, and also the latest export control on the tech and critical minerals. But now with the one-year truth side, it suggests that both sides are moving to the interim equilibrium. Each side has a card to play. The US advanced semi and chip and China's rare earth proved to be very effective card to play. And we think the technical pause will lower the near-term geopolitical risk, and also the proposed Trump-Xi meeting in 2026 could also help to anchor a steadier US-China relations. So under the three scenarios, what's the market and the sector implications? First, in the base case, we think we assume the one-year truth, but with some back and forth frictions. So in this case, we expect global investors will have higher confidence on China assets, and also this will lead to a lower equity risk premium. And MSCI China could maintain the valuation around 13 times PE. This is in line with the broader emerging markets valuation. And at the sector level, we think it will benefit the AI-related names. The localization theme remains intact, given that the advancing AI self-efficiency is still a central policy objective for Beijing's agenda. And we think in this scenario, it also benefits the export names, given we currently have the improved tariff visibility and a more predictable global demand. This could support the order recovery and also the capacity planning. So in our report, we provide a China AI 60 stock list. These are the top 60 names on China infrastructure, including the semi, hardware, data center, and power, and also the names on the AI platform and AI application for investors to engage in the China's localization themes. And also we provide a list of top 30 Chinese companies with the highest US revenue for the export play. So this is for the base case. And then in the bear case, if the truth collapses with the tariff hike and also some non-tariff barrier introductions, we think it would lead to MSCI China valuation to derate to below 12 times PE, given the shock on the earnings visibility and also the equity risk premium. So in this case, we think investors should rotate to domestic names like consumption and services, given that with the external shock, normally the policymakers will have more incentive for the domestic stimulus. And these domestic consumption and service names could see a more stable demand and also the growth side. And we also think that under this scenario, we could rotate more to the high dividend and defensive sectors, including like utilities, telecom, energy, and banks, because these defensive sectors with high dividend yield tend to outperform when the market see meaningful pullback. And for the AI-related names, we think the bear case will lead to some initial correction, given the high beta nature of the AI names. But the bear case should reinforce and accelerate Beijing's push for the technology self-reliance, so which is positive for the AI names in the medium term. And lastly, in the bull case, if we have the sustained easing of the U.S.-China tensions with a framework trade deal, we think it would enhance the earnings visibility and reduce the equity risk premium. MSCI China will re-rate to 14 times PE. So on the sector-wise, if we have in this bull case, we think this would definitely benefit some high beta growth sectors, including software, internet names, and auto, etc., and also benefiting some export sectors. While for the AI names, we think if the AI chips purchase is allowed from the US, then the overseas vendors like Nvidia and AMD would likely to get meaningful share in the China's AI comes to market. So this would be negative for the AI localization theme names. So with that, I will stop here and pass it back to Crystal. Thank you so much, Jenny and Chloe. Since both of you have to leave before a certain timing, then maybe I'll just ask the questions on China export control first. The first set of questions are for Jenny, because a lot of investors have been asking about how does the licensing process really work. Can you maybe provide more details on that front? And then also, is it easy for the other corporates to really get the licensing within a short period of time? And then secondly, how do you see what may be the triggers for China to further tighten the export controls? So that will be for Jenny. And then, I will ask the question for Chloe after that.
Yeah, sure. Thanks. So there's an interesting discrepancies between the White House and Beijing's descriptions on rare earth truths. For the White House, they issued a fact sheet on November the 1st, and they said that China will issue general license on rare earths, and they will factually disable the Apple rare earth controls. But on Beijing side, Beijing just said that they will evaluate the actual situation and do the general license issuance. And in reality, what we know is that the license issuance is still under study, and issuance could be relatively slow. And also the license will be issued case by case with 1 year maturity. So in other words, China still have the discretions on the coverage of the license, which company and countries to issue, and whether they will roll over the license after the 1 year maturity. And we think like military or like national security related sectors will remain difficult to get a license. And what could be the trigger? If a U.S. or U.S. company or U.S. allies were to block the exports of the chips and some advanced technology to China, then we think that it's possible that China will also do some selective targeted export controls to these U.S. allies or like companies. Just as we can see that China's officials with Netherlands hasn't fully settled down because of the some export controls by Netherlands on the SUVs to China. So China may also there is also a possibility that China may also like increase the like rare earth controls on countries like Netherlands or some similar cases in future. Let me stop here.
Thank you, Jenny. And just a very quick follow-up. So just now you mentioned that the October controls have been kind of reversed, but then the April controls are still in place. So it means that the controls for rare earths for magnets are still in place, right? It's still blocked.
Yes, that's right. And whether this can be reversed depends on whether China will issue a general license. So basically, it's a license-based export control. If you get a license, then you can get the rare earths from China. But if not, then it's still blocked.
Great. Thank you. That's super clear. Thank you, Jenny. And then there's another question for Chloe on the export control front as well. So how much do you see people are pricing in any further escalation, and then or people just assume that it's gonna be the base case of the more sustainable truth?
Yeah, thanks, Crystal. I think so. If we look at starting from end of September, so first the U.S. have escalated the conflict with China. So they, for example, they added the entity list. This will apply to the subsidiaries with over 50% control. And then in early October, China has tightened the rare earth export contract, etc. And then after the deal in late October, these two are reversed. So basically, we are back to the pre-September situation. And beyond that, we also get additional 10% tariff cut on the fentanyl side, and then we have a longer truce period extended from previous 3 months and to currently around 1 year. And if we look at the market reaction, I think actually after the trade escalations, the market didn't correct that much. On the index level, I think the market corrected by around 2 to 3%. And then after the deal on side, I think we didn't see much rebound because the market didn't correct very much in the beginning. So I would say that with current valuation level, I think the market hasn't fully pricing is like a 1 year truth, and also we get additional 10% tariff cut, and that would be positive to some export related names. So that part I think the market didn't really pricing, and the reason is that potentially is that we are moving towards to the year end. I think the risk appetite for a lot of investors has coming down, and given that they made quite a decent profit year to date, so some of them want to take more profit towards the year end and re-engage in the next year. So I think for the next year, I think our view is more constructive. Despite the near term, I think the risk appetite for the market may be a bit lower.
Got it. Thank you so much, Chloe. So now we'll move on to India, and then there seems to be some green shoots during the festive season according to the high frequency number tracked by our India econ team. Today we have Prasanna to share more color on growth and then if India is coming out of the cyclical slowdown ever since the third quarter last year.
Thanks, Crystal, and hi, good morning, everyone. I will just share my screen for a few charts. And so what we are seeing in terms of high frequency data here is that there are signs of pickup in growth after it remained muted in the last couple of quarters, especially in the festive season. So some data points that we can highlight here are the passenger vehicle and two-wheeler sales, which we see in the table. Those are up on a like-to-like basis in this festive season versus the last year's festive season by about 25%. Similarly, credit card spends are also up nearly 18%. We are seeing pickup in certain other broad-based indicators as well, especially if you look at credit growth, which is on the chart on the left-hand side. That's up to 11.5% in October. That's almost a year, the highest in the last 12 months. GST collections are also holding up. So while obviously YOY numbers are lower, but if you were to adjust it for the potential revenue loss, then GST collections would also be up nearly double digit at 10% on the month of October. And if we see the chart here in terms of INR trillion, that is still holding up in terms of the collections in October, even though there was a rate rationalization that has happened. So there is evidence that volume-based pickup is also helping in GST tax collections. Similarly, services manufacturing PMI continue to remain above 58, 59 levels, pretty much at very strong levels. And we have certain other indicators as well, not mentioned here, but what we have picked up, like retail sales during this festive season were up 25%. Similarly, e-commerce industry has also recorded an uptick of a similar magnitude of nearly 24% in terms of order volumes in the festive season related spending. All in all, see green shoots in terms of high frequency growth data. And we do think that this will be sustained. Certain factors which will especially help the consumption related recovery are the policy pivot that we are seeing in terms of both monetary and fiscal policy support, improvement in improvement in real wages and both rural and urban. So if you look at the charts here, we are seeing a pickup, especially in rural wages, and also a pickup in at least a bottoming out in the urban wage expenses as well. Some improvement in the Naukri or the employment indicators as well. So CYTD, the numbers are up versus 2024, where the organized sector job growth was declining. And fiscal support, as we were mentioning, both through direct, indirect tax cuts and the expected pay commission, which we will have more clarity in the next 12 months. So all in all, a lot of tailwinds to consumption growth and support and recovery, which we think will continue to define India's growth story, with domestic demand being the key driver in the next 12 months. Another data point that we've got last evening, and that also feeds into this story, is the continued moderation in inflation numbers that we are seeing. I'll just highlight that chart here. What we are seeing is a continued, slowdown in inflation. Sorry, I just yeah. So if we look at the chart on the left-hand side here, we have seen inflation moderate to an all-time low, led by both base effect, food price disinflation, but also continued moderation in core. If we were to look at core, which strips out both petrol, diesel, gold, silver, that number is down to around 3% and below 3% now in the latest reading. So we also have the GST impact feeding into lower, keeping inflation at very benign levels. It is also getting corroborated in the inflation expectations chart on the right hand side, with inflation expectations continuing to see a moderating path. So this will again be another factor which should feed into easier financial conditions. We do think in our base case that there is likelihood of another rate cut, at least by the RBI in the December policy, given that inflation is likely to be undershooting RBI's estimates. So with benign macro stability, especially inflation, we do think that in financial conditions will remain easy, and that will be another factor which will help improve the momentum in domestic demand. So to conclude, as I mentioned earlier, we see domestic demand to be the main driver of growth, supported by both fiscal and monetary policy being pivoting in favor of maintaining growth momentum, and that will drive India's growth trajectory to around 6.5% in the next 12 months. I will stop here, Crystal, for any questions and pass it back to you.
Thank you so much, Upasana. So now we will move on to the Q&A session. The first set of questions are for Chetan. Maybe I'll just ask them one by one then. Seems like China property market has worsened further this year. So how do you see the incremental bad news, and then whether that will further dampen the consumption trend in China? Maybe you can take the first question first.
Yeah. So on property prices impact on household consumption, we think that is a factor. It's definitely a steady state negative factor for China's household consumption spending. But the impact is coming in more indirectly, in the sense that to the extent to which property sector is going through this decline, policymakers are trying to defend real GDP growth with investments, and that is creating the challenge of excess capacity and deflation, and therefore downward pressure on nominal GDP growth and wage growth. So it's this route which is the negative effect of property market, rather than just property prices falling and having a negative impact on the consumer spending. So yeah, I mean, it is definitely not helpful, but policymakers could have, for example, responded differently, in the sense that not take up more investment growth on the face of decline in property sector, but take up social welfare spending to support consumption. That response is what we think is a bigger challenge in China than just the fact that property prices are falling. Property prices will fall because they are going through a structural adjustment in the context of the demographic situation in China. But it's this policy response and its ramifications on deflation and wage growth we think is more important.
Got it. Thanks, Chetan. So how is wage growth trending in China currently? And then how do you think China can stimulate the wage growth in a sustainable way?
Yeah, so wage growth has decelerated. It's down to around 4%, and therefore retail sales is also down below 4%. And the way you can accelerate wage growth is precisely the way I was mentioning earlier, take up a policy response which lifts consumption through social welfare spending. We've always argued that the migrant workers in China, over 300 million of them, have a saving ratio of 46%. National saving ratio in China is also very high at 31%, compared to, let's say, India at 22 and US at 5. So this extremely high saving ratio for migrant workers can be addressed by giving them access to public healthcare, education, and housing, which the government is providing to the other legal urban residents. So it's not a solution which has not been implemented for anybody in the society. It has been implemented for the legal urban residents. If it can be done for the migrant workers, that can help them run down their saving ratio, which means a better multiplier effect in form of consumption growth in the economy. And then that can help them not to go ahead with excess investments, which gives us a double benefit of one round of consumption pickup lifts capacity utilization, and they have less pressure to create new excess capacities. And that combination can then help drive inflation from deflation to inflation, and then lift nominal GDP growth, wage growth, and consumption. So that's the way out. As of now, we think that the approach that the policymakers have taken is going to help, but it's going to be a very long battle to get out of deflation and address this wage growth and consumption problem.
Thanks, Chetan. And then we have another two questions on India, but then I guess that's for both Chetan and Upasana. So the first one is, how do you see the China-India relationship given their competition on the manufacturing front? And then the second one is because there may be some disruption from AI to the Indian economy, and then do you see the growth to be multifaceted in India, and then that will be strong enough to kind of weather the storms from AI?
Yeah, I can take the China-India relationship bit, and Upasana, if you can take the AI one. So on the China-India relationship, we think it's probably likely to continue to stay on the improving path. And just to highlight the point that the relationship is here to say, by explaining one or rather giving you the stats on how India and China trade has evolved. So in 2020, when there were some border issues that India and China faced, India had a trade deficit of $40 billion with China. And today that deficit is expanded to $120 billion. So despite the relationship being lukewarm, you had such a strong rise in trade deficit and the trade between India and China. And now, to the extent to which the relationship has improved, we think that the trade is going to increase even at a faster pace than what it did in the last 5 years. So, yeah, I think the relationship is going to be resulting into better trade numbers between the two countries. And I think it's in that sense accretive to the both the countries' growth dynamics. Upasana, over to you.
Yeah. Thank you, Chetan. On the second question on impact of AI, what we are seeing is that in terms of the capex related impact, we are seeing certain positive developments with announcements of data centers and expansion of the same. So in that aspect, there is some nascent signs of probably pickup in AI related capex. It's of course very, very nascent and it will take time. But there is a momentum that is now coming through with large private sector companies announcing large data centers and even foreign multinationals announcing the same in different parts of India. We are also seeing some pickup in capital goods imports related to the AI related capex. Again, these are nascent signs, but further corroborate this point. In terms of the aspect on how AI adoption and its impact on the labor force, and especially from an IT related probably sector's employability perspective, how that impacts, that of course will have certain more challenges because it would involve skilling or reskilling of the workforce. Again, there are initiatives that the government through its skilling programs and through partnerships with private companies and private sector on its own is also taking up to further enhance skilling and adoption of AI related skills. There are news flow which indicates that a number of that almost 40% of India's gig sector employees are employing AI and AI related skills in certain forms and fashion. So I think it would be evolving, but in all, we do, as of now, don't see AI as a major headwind or disruption to India's growth trajectory, both from a medium or a cyclical perspective. Government's think tank, which is Niti Aayog, has recently put up a report on AI and its impact on India with a medium-term perspective. In it does give a more positive take on this, and their estimates indicate that AI could add about $500 to $600 billion to India's GDP by 2035. I'll stop here.
Great, that's super clear. Thank you both, Chetan and Upasana. So there's another question online, and then it's about whether so the other countries are working on the diversification of rare earths, and then how soon the results will be visible. So Jenny's not online already because she had to luncheon, but then we have asked Zhipeng and the China Econ team, and also our China Materials had Rachel about this question quite a few times. So they mentioned that it's not actually just about mining; it's also about the technological know-hows. So Rachel mentioned that it would take other countries at least 3 to 5 years for them to make any progress. So yeah, it's not gonna be a very near-term kind of thing for them to make progress. So in that case, in the interest of time, we'll conclude today's webcast here and answer remaining questions offline. And then also a reminder that there's no webcast next week. And then for anyone that's coming to Singapore, we will see you at the summit. Thank you so much for joining today, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.